So we'll now start with income from house property. 5 heads of income, the first one being salary, second one being income from house property. Salary, we discussed under 3 sections, 15, 16, 17. And income from house property, we start discussing from section 22 to 27. 18, 19, 20, 21, we don't have those sections currently. Okay. So 15, 16, 17 we discussed in salaries. 22 to 27 we are going to see in this chapter. Though salaries having only 3 sections but consumed more hours to cover. But in income from house property 22 to 27 almost 6 sections we have, but we can finish up just like that. Okay, matter of 3 or 4 sessions we will finish up this topic completely. Right. Section 22 to 27. Now, we'll start with section 22, charging section. To consider whether letting out of the house property will be taxable under this head or not, or if you are having residential house property or commercial building, whatever it may be, a property, will you pay the tax under this head or not? If it is so, then at what time and on what basis you have to pay the tax? All these things are explained under section 22nd. And usually, income rent free means especially house property being annual value. Annual value will be the income. Is that okay? What is called annual value? It is not the rent actually received. What could be the rent receivable for that based under some standard fixed, that will be considered as income. Is that okay? So in case of salary, you employed and you work and you get the salary. If you are receiving the salary, you are going to pay the tax. You have 4 house properties. Okay, remains unoccupied. Okay, well, you need to consider there is any income from house property or not. Yes, of course, you need to consider. If you have 2 or 3 houses, then definitely you have to consider rental income as part of your income. So if you don't say that I don't have even single paisa received as a rent, sir, you cannot argue that. It's a notional based. And income will be calculated based on the annual value. Property income. This will be called as property income. Property means buildings and land appurtenant thereto. Okay. So buildings and land appurtenant thereto. If you have the building, okay, if you have the building, clear, and you have the compound also. This is a building, this will be called as land appurtenant thereto. From the door, a road approaching or a path approaching the main road also being called land. Is that okay? This will be building, this will be land appurtenant thereto. These two will be considered for the income from house property. If I have only land, what happens, sir? Do I get any revenue from having only land? Of course, you can let out the land also in peak areas for the parking purpose currently. If you are letting out of the land for parking or some other reasons, some other purposes not being the house property, this will also be considered as income only, but this will be considered as income from other sources. Okay. So land only, if you are letting out and getting the money, that will be considered as income from other sources. If it is being the land appurtenant thereto, then it's called rental income. Land appurtenant thereto is nothing but land in association with the building. Okay, any path approaching the road and within the compound area, all will be considered as land appurtenant thereto. That building along with the land appurtenant thereto, if you are letting out, that will be considered as income from house property. Okay, that income in this case is nothing but annual value. What is called annual value? It's a notional value based on the assets. We'll see that in detail in the subsequent lecture. So our main motto is to calculate annual value in case of income from house property. And who has to pay the tax? Assessee. Assessee is nothing but the owner. Usually beneficial owner will be responsible for paying the tax. Okay, not the registered owner. Even sometimes the deemed owner should also be liable to pay the tax. Who is going to be the assessee in case of residential house property? Only the beneficial owner will be the assessee. Is that okay? So, for income from house property, income means annual value. What is annual value? We'll study in the subsequent lecture. And property means building and land appertinent thereto. Appertinent thereto. The term used for representing the land in association with the building or any path or within the compound for the building, everything will be considered as land appertinent thereto. Okay. And who has to pay the tax? The assessee. Who is called assessee? The beneficial owner. For example, Mr. A and his minor son or Mrs. A. Okay, Mr. A has two residential house property. Mr. A transfers one of the residential house property to minor son's name, another residential house property to Mrs. A. Now, these two residential house properties are in the name of minor son as well as Mrs. A. Now, the income from this house property being 5 lakhs and for this it may be 10 lakhs. Now, who has to pay the tax? The tax will be payable only by Mr. A. Okay, ultimately, Mr. A has the control over the income of these assets now. So, automatically, all this income will be clubbed in the hands of Mr. A. He is being the beneficial owner. Though the asset may be registered under the spouse and minor son's name, of course, finally, it is going to be taxable only in the name of beneficial owner. So, you have to understand the difference between beneficial owner and a registered owner. If the house property is transferred from by Mr. A to Mrs. A, and for that a consideration say 100 lakhs is given by Mrs. A, then not required. Here the asset is transferred without consideration. It means to forgery like. So automatically the beneficial owner being Mr. A, he has to be the assessee and he has to pay the tax on this income. Clear? So 3 parts we have covered. Income, annual value, property being buildings. Building alone can be falling under income from house property. I don't have the land. Can I have the building? Okay, possible. In some cases, we may take the land in lease for 10 years, 50 years. Some case it may be 99 years. 99 years lease may be taken for the land. And on that land, I may construct the house property or any building. Is that okay? In that case, I am the owner for the building, not for the land. Is that okay? I am owner for the building, not for the land. Who has to pay or who has to consider for the taxation purpose? Only the building owner, not the land owner. Is that clear? Clear. So usually 99 years lease. Okay. So many entities are now they go for getting 99 years lease. Okay. I don't know why and how they have this 99 years concept. I'm not aware about that. So I still remember the landowner has given his Mr. A has given his land to Mr. B, okay, with lots of coconut trees. It's not sold, 99 years contract, lease. And who is the real owner? A is the real owner. A has given it to Mr. B for 99 years lease. Okay, he is being the farmer. A being the farmer, is fond of growing all the trees. And Mr. B, now and then he simply cuts and makes this place for his own comfortable small area like hut and other thing. He continuously does so habitually. Then there's a big fight between these two. He visits to his own office and says, "Sir, I gave the land not to cut the trees." Immediately Mr. B says, "No problem. Come back at 99th year. I will replace all the trees as it is." At the end of 99 years, he is already 70 years plus. This fellow is already 70 plus. And he has to come after 99 years. I don't know what's the logic behind that 99 years of lease. Okay. Even in Chennai, no, Vivekananda house is there, I think. How many of you heard about that? Huh? So in Beach Road, there's a Vivekananda house, I think. The land is for somebody else, and Vivekananda visited and stayed for a couple of days after returning from Chicago, some foreign trip, right? So in memory of that, they constructed a building there, and it may be now available as a meditation center and all. 99 years got expired. Now the question is, how can we dismantle that building? Then it went to the court and all the trouble also faced. Okay, Vivekananda, the home at Chennai Beach. Okay, Chennai Beach Road. Okay, 99 years lease. Let's see. Vivekananda House, formerly known as Castle Kernan, is located in Chennai's Beach Road and is leased for 99 years. Surprisingly, we are in the age to see the end of 99 years lease. No more Vivekananda, no more the person who giving that in lease, and lessee lesser no more exist now. It was there that Swami Vivekananda stayed for a period in February 1987. In 1963, during the centenary celebrations of Swami Vivekananda's birth, the Tamil Nadu government renamed the buildings as Vivekananda's Illam. The building now serves as a museum and art gallery. So 1897 was a case where we faced the issue. Then again restarted now. Again it's still working as a Vivekananda's Illam only, I think. Lease of Vivekananda House for 99 years. So President Chennai, all these things you can go and see that. Hope you will be now able to understand. 99 years is a very famous case. In our lifetime, we have seen a case after completion of 99 years of lease. Right. So similarly, I can procure the land with the 99 years of lease without ownership. I can construct the building over there. So I expect the building maybe for only 30 or 40 years. Beyond that, the building will not have the sustainability or power to withstand. So in that case, I am the owner for the building. Then any rental income for the building, I need to be paying the tax. I need to be the assessee. Is that okay? Now, income property assessee. House property could be in foreign country also. Okay. If the house property is in India or foreign, what happens? If the house property is in foreign, what happens then? Okay. Now you have to check whether the rent is received in India or outside India. Okay, if the rent received outside India, then it's a foreign income. That will be taxable only for the ROR. If the rent received in India, then it is Indian income, taxable for all the category. So, in case of ROR, everything will be taxable, whether it is received in India or outside India, whatever it may be. In case of NR and NOR, taxable only if it is received in India, because if it is received in India, then it is Indian income. Is that okay? So, house property in India, ROR, RNOR, and NR. Taxable. House property in USA. Okay. In the second case, received being in India or in USA. If the rental income received in India, then automatically it is Indian income, taxable for both the cases. If the rental income received outside India, then it is taxable only for ROR, not for here, not for NR and NOR. Okay, or NOR. Clear? Now, income from house property will not be applicable in what are the scenario? These are the scenarios. Okay. Property occupied for own business or profession will not come under this case. You understand? Now, house property, owner being A. Okay. So, owner being A, occupied by A. For what? He can occupy for residential purpose or his business purpose, commercial purpose. Residential purpose or commercial purpose. In case of residential purpose, this will fall under income from house property. In case of business purpose, if own house property is used for his own self-owned purpose business, it will not fall under income from other sources. It will be anyhow adjusted under PGBP head. If the property is occupied by B, owner A lets it out to B. Okay, he uses for either residential purpose or for his personal business purpose. In both the cases, it comes under income from house property only. Income from house property only. Is that clear? So, in total, we have four varieties. In these four varieties, this will not come under income from house property. This will be dealt under PGBP itself. So, along with the PGBP, you will learn that later, not here. Now, assume that these are the scenarios you have to come across. Okay, these are the scenarios you have to come across. Maybe self-occupied for own self-occupied purpose, residential purpose, and self-occupied for residential purpose, and let out for residential purpose, and let out for commercial purpose. Self-occupied for business purpose. Okay, self-occupied for business purpose. Four categories. If you are self-occupying that property for self-occupation purpose, maximum 2 house properties are allowed. Beyond that, if you have 4 houses, you are staying there only. Okay, weekly once you stay in one house property. House property Trichy, a week, and then B another week, coming rotation. So if you are staying 4 house properties, then only 2 house properties will be considered as self-occupied for the residential purpose. Beyond the 2 house properties, even though if you are using for the residential purpose only, you are not letting out even for single penny. This part will be considered as deemed to be let out case. Maximum 2 house properties can be used for your residential purpose. Beyond that, if you are holding any other house properties for your own residential purpose, that will be considered as let out only. Sir, I possess myself, sir. I don't get any rent for that. No need to worry about that. I will fix a rent for this notionally. That will be your income. As already told you, in case of rent from house property, we have to calculate the rental income based on the notional value, not the real value. That notional value, how can we arrive, sir? Go and refer the annual value calculation, section 23 onwards. Is that okay? So, self-occupancy, more than 2 house properties. Up to 2 will be residential house property, self-occupied. Beyond that, self-occupied for the residential still will be named as deemed to be let out. And if you are really let out for, the let out could be for residential or commercial purpose. Doesn't matter, you can treat the same way. So, this is let out portion. If you are using your own business, your own property for your own business purpose, then this will not fall under income from house property. So what happens? You have to understand self-occupied for residential purpose, deemed to be self-occupied, deemed to be let out case, then let out case. These are the 3 points you have to understand. Self-occupied for commercial purpose is not in the scope of income from house property. Is that okay? Self-occupied for the residential purpose, maximum allowed being only 2 house properties. This will be house property in excess of 2. Any house property beyond 2 will be called as deemed to be let out. And let out may be residential or commercial purpose. So these are the 3 calculation mode you have to cover here. Okay. So, from this it is very clear, property occupied for own business or profession is not considered for the income from house property. Clear? Clear? I have given all the list here. Let out for residential and commercial purpose, self-occupied for residential purpose, up to 2 house properties, Self-occupied for residential more than two house property named as deemed to be let out, and self-occupied for commercial purpose is not considered for the income from house property purpose. So these are the 3 points I explained here. For each and every aspect, we will be covering some illustrations. So almost 7 different practical problems I have incorporated here to master the income from house property chapter. Okay, hope now you'll be able to say let out case, whether it may be residential or commercial purpose, the treatment is same. Self-occupied for residential purpose will be treated separately, but maximum number of house properties can be used for self-occupancy being 2 house properties. If you are using your own house property for your own commercial purpose, your own business will not be falling under this head, so it is excluded here. And third one is self-occupied for residential purpose in excess of 2 house properties. If you are holding more than 2 house properties, up to 2, you can treat this being the self-occupancy. Beyond that will be considered as deemed to be let out. So how to deal that? So that's sort of a third one. So these are 3 aspects you have to cover. Now, what is not falling under this section 22? Property Act occupied for own business or profession is not falling under income from house property. If the TCS company for their employees providing quarters and employees are paying a rent. Now the question is, will it be falling under income from house property? What's the objectives of TCS? Running the software company, okay, IT supports. For that they need to have a set of employees. But to acquire the employees, they need some facilities like quarters or rent-free accommodation. So immediately TCS has built quarters where they are accommodating the top officials there for a nominal rent. So TCS main intention is not to let out that property for their employee. To do the business much better way, they are offering these quarters additionally to the employees. So this rental income is not coming under income from house property, will fall under PGBP. TCS seems to be a big campus, understand, and maybe around 1,000 or 1,500 employees may be working. So TCS wants to facilitate them with some ATM facilities or within the campus some bank. So TCS approached some bank here, probably SBI. TCS approached SBI bank, and SBI bank now runs their ATM service or small office here. So TCS offered them house property, and SBI now runs ATM and small office to support the employees here for any deposits as well as withdrawal. For that, SBI has made a payment here, rent is paid. Now what about this rent? Again the same question comes, what about the TCS intention? To let out to SBI and earning the rent is not the intention. The intention of letting out is to help their employees. So it is in connection with the business only. So the rental income from SBI bank will also be falling part of PGBP. Not only SBI, it may be sometimes police stations, sometimes some government departments, for example, excise department. So if I am being the manufacturer, now and then I need to be investigated by the excise department, or I need to get the approval from them very often. So I thought if the excise department has their office within our campus, whatever the emergency may be, we can immediately resort there. So we now give the house property for the building rental to the excise department, to government departments, any government departments, and we are getting the rent. And this one is with the intention of running the business smoothly. Then that rental income will be the PGBP income. Hope you will be now able to understand. The following are the PGBP. Let out is for the promotion of its own business or profession, like let out for employee, let out for government agencies and banks, let out to ancillary units, some ancillary units, okay, to carry over some subcontract work of TCS. No, they will debut some ancillary units and ask them to work within our own campus itself by charging small rent. That rent is also coming under PGBP. Hope now you'll be able to understand. These things are not falling under income from house property. This will be adjusted with the PGBP, and this will also be falling under PGBP. And if partner's property used by the firm, then also be considered as not income from house property. Okay, just similar to the own business property of the owner used by the owner himself, right? Similarly, XYZ is the partnership firm where XYZ three partners are there, right? Where X holds the house property, and that house property used for running this XYZ business. As one of the owner is the owner of the property, the rental income from this partnership firm to X will not be considered as income from house property. And even next one being, my intention is to construct flats, okay, flats, and maybe I may have hundreds of houses. Okay, the intention of buying and keeping all the houses is to let out only. In my objective class itself, while company registration, you have to give the memorandum of association, right? So objective class. What's your objective class? Letting out of my property for rental income is my objective class. With that objective class, director is also there, and the team is also working behind, and rent is also collected. Where I'm treating the rental being the business like. Shown this being my objectives in my memorandum of association, then this will be considered as PGPP only. Is that clear? So section 22, what are the condition and who is liable to pay the tax for income from house property is the charging section. So here income being the annual value, property being building, not the land alone, but land appurtenant thereto, and assessee being the owner, that too beneficial owner is the matter. Even sometimes deemed owner will also be matter. So who is called deemed owner? So we'll study under section 27 later on. And house property in foreign countries are, house property in foreign countries taxable for ROR. In case NR and RNOR, if the rent is received in India, then it becomes Indian income, it is then taxable. Okay. And these cases, it is not taxable under income from house property. What are they? If the property is occupied for running the own business, and sometimes for the promotion of their own business and professions, the property is let out, then that let out is not considered as income from house property, also part of the PGBP income. Partner's property occupied by the firm is also not considered as income from house property. And the business objective is to let out the property, then it is called PGBP only, not under income from house property. Clear? Now, section 23 deals with annual value calculations. Annual value calculations. So for the annual value calculations, you have to cross refer four rents. Four rents. Okay. So what are the rents you have to study here? You have to understand municipal value, and fair value or fair rent, and standard rent, then annual rent or actual rent or rent received. So we have been given four rents here. Okay, what is called municipal rent? For the municipality, corporations, they levy the property tax, isn't it? For the levying property tax, no, they determine what could be the value of the assets in their locality. Based on that, they will charge. Usually, no, 1 month rental earnability will be the municipal tax, or 10% of the yearly rental income will be the municipal tax. Is that okay? In Trichy locality, you have the house property, and this house property capable of earning around 1,20,000 rupees as per the municipal expectation. then it is called municipal value. They will have their own record. Usually, municipal tax is calculated based on some value on this. Probably, if it is 10%, it means you have to pay tax at the rate of 10% on this 12,000 rupees. What about the rental income, sir? So you cannot cheat. Government says, I never refer your actual collection. You may collect the cash, the rent in cash, but you hide that you don't collect it at all. So government may be getting cheated. So very simple. They never ask about what is the rent you actually receive. What is the tax you are paying to the municipality or corporation? For the payment of tax, they have the base value. That value is called municipal value. Based on that, you have to find out the rent. The rent calculated as per the municipal valuation being 1,20,000. Apart from that, it is Trichy. And nearby, one more fellow is also having the same house and same size. This fellow says, my rental income in his own tax return as 10 lakhs. As 10 lakhs. If you show your income being 1,20,000, no need to worry about. The department directly will start sending a query. Your neighbor gives me 10 lakhs revenue, shows me 10 lakhs revenue and pays tax based on that, but you are showing only 1,20,000. Give me explanation. Then that's all. Next day you will search on some auditor and all, you will pay the fees and everything will come. So fair rent is nothing but the rent in that locality. Maybe around 2 lakhs. Maybe around 2 lakhs. Also be considered fair rent. So always remember, you may show one value, but nearby another fellow may show the other value. These documents are available, right? So you pay the tax based on your own details, stating your locality where you live and your property size, and immediately the income tax department, not income tax department, that software. Today AA is brilliant than us, right? So the AA will easily compare. This fellow is also living in Trichy, Tilanagar. That fellow is also living in Trichy, Tilanagar. This fellow pays 10 lakhs rupees as income and he shows only 1 lakh. No problem. We'll visit his own house. Okay. See, if you pay the tax, you have to pay the tax at the rate of 30% at the higher rate. And of course, 4% you have to pay health and education cess. If they find and come to you and ask you to pay, then the tax rate will be for 30 plus 30 plus 25. Almost you have to pay 78% on your income. For the 10 lakhs, no, you have to pay 7,80,000 rupees as tax. Because that's a searching cost, no? Finding you after searching. So they will demand a lot. So if you are hiding any profit, they will recover it somehow, charging at the rate of 78, maybe penalty, right? So always remember, municipal value, I never refer your actual rent. I just have two other base rates for the valuation purpose. One is municipal value, next one is fair rental. Third being, some places in India, not all the places, there may be Rent Control Act applicable. Okay, some areas, the rent may be exorbitantly fixed, unethically. Then government comes for the rescue. The government says, in this locality, you cannot fix the rent beyond this rate. That's how the government comes for a halt for fixing the higher rent. In Chennai and in Bangalore and all the places in Mumbai, suddenly the rate was shooted up. Okay, when economy in Bangalore was shooted up due to the IT, all the population shifted to Bangalore. Okay, so I could still remember 20 years ago when I was in Bangalore, coming out from the room and hall seems to be very shivering, so chill. Now it seems to be very hot and very tensed. So I just asked my cousin to take me to one of our friends, common friends' home. He told me, do you want to visit there quickly or slowly? Then I said, I have to go fast because I have to return my home to Trichy. Take me by car. No, 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 no. If you want to go fast, then you have to go by walk. You can finish watching and meeting in the hall within half an hour. Otherwise, if you go by bike, and it may be 45 minutes. Car, by tomorrow you can go and see him. So that was the scenario we have there in Bangalore. So because of the population explosion, automatically what happened, huge tariff. Rent was exorbitantly high. Right. Then immediately Rent Control Act came there. Okay, they'll fix, you cannot fix the rate beyond this. So it may not be applicable for all the places in India, but some places. If it is applicable, these two rent will not be beyond this one. Say for example, 1 lakh. Okay. So you have to compare these three rents. So we have been given three rents as such now. One is municipal value, another one is fair rent, third one is standard rent as per the Rent Control Act. It may be applicable or non-applicable. If it is applicable, then take that rate. And then finally, I am coming for your actual rent receipt. What about your actual rent receipt, sir? 1 lakh 50. Okay, now I'll consider. So four rents are there. Four rents are there. So municipal value, fair rent, standard rent, annual rent. If you say, sir, my rent is only zero, sir, no worry. I have these three values, and based on the three values, I'll fix what could be the rental income you earned. For that, you have to pay the tax. Is that clear? You cannot escape. You cannot escape. Clear? So, notional income instead of real income. We are not going to take the real income, we are going to take the notional income. How can we calculate, sir? Let's see here. I have given four rentals. One is municipal value, another one is fair rent, another one is fair rent. Between these two, whichever is higher will be taken. Whichever is higher. Okay. So municipal value or fair rent. Central government says, income tax department says, I will compare these two. Between these two, higher number will be taken. And now I cross verify with the standard rate. If standard rent is applicable in that locality, whether it is applicable or not, you have to first verify. If it is applicable, what does it mean? There's exorbitant rent hike. So government fixes a base rent, you cannot go beyond that. Floor cap rate, you cannot go beyond that. So you cannot fix beyond that means this rent should not be beyond this, right? So then whichever is lower. So municipal value being 100, fair rent being 120. Comparing these two, whichever is higher will be taken. If the fair rent is there, probably 80 rupees. The fair rent applicable, standard rent applicable in that locality is 80. Then the municipal value and fair rent both put together should not be beyond the standard rent. So finally 80 rupees you will get. This 80 rupees is called expected rent. So you have to pay the tax on this 80 rupees only. This is called expected rent. If you show your actual rent is 90, government is very happy. If you are showing more income, government always appreciates your growth. Parallelly, government also appreciates tax growth also, right? So both appreciates you and appreciates for the tax revenue. Both will be parallel, right? So expected revenue 80, your actual annual rent should not be less than that. So annual rent. Okay. Annual rent or rent received. I will get back this one to be discussed in detail next. If the rent is only 90 or 70 or 110 or okay, 70 or 90. In case 70, between these two, whichever is higher will be taken. What is higher value? 80. Between these two, which value will be taken? 80. 90. So at any cost, your rental income should not be less than expected rent. If you are showing beyond that, very happy. Government will be very happy. Is that clear? So four rents are going to be compared. Four rents are going to be compared. Now, this will be called as gross annual value. So we are comparing four values here: municipal value, fair rent, standard rent, annual rent or rent received. So this one requires more clarification. I will get back in the next illustration. Very first illustration, I'll start with the annual rent. So using the four, we can calculate the GAV easily. From the GAV, we can subtract only one item to get the NAV, which is nothing but municipal tax you pay. Sir, I'm paying okay, this may be revenue, but I'm paying the municipal tax, sir. Yeah, of course, you can simply debit or reduce this one, municipal tax. To reduce that municipal tax, two conditions should be satisfied. Two conditions. What are the two conditions? Should be paid in that financial year. Okay. In the same previous year, it should be paid, not only paid, should be paid by the owner. Okay, sometimes it may be let out and owner asks the tenant to pay this amount out of his own pocket money. So then it is not your cost, your expenses, so it cannot be deductible. If it is not paid, you cannot deduct. You can deduct only in the year in which you are making the payment. You don't pay municipal tax for more than 15 years. All the 15 years put together, at a stretch you are paying in the current previous year. How much can be deductible? Entire 15 years payment put together, it can be deductible in this current year itself. So in the year of payment. Is that clear? After subtracting municipal tax, what you get, is called NAV, net annual value. Clear? Yeah. Let's start with the first illustration. Calculation of net annual value. Singer furnishes the following particulars in respect of his house properties let out for the previous year 24-25. Determine their net annual value. So municipal value, fair rent, standard rent, annual value, and municipal tax also be given. So municipal value, fair rent, between these two, whichever is higher will be taken. Whichever is higher will be taken. We have been given 4 house properties, all the 4 being let out only. In thousands. Okay, 400,000, 300,000, 150,000, 260,000. And fair rent in the market being 420, 370, 180, 240. And whichever is higher, 420, 370, 180, 260. Now you have to go for the next one. What's that? Standard rent. In case of standard rent, between these two, whichever is lower will be taken. That will be called as what? Expected rent. This is called expected rent. Standard rent applicable here being 350, 380, 170 and 280. So the logic behind this one is legally controlling the exorbitant rent. As legally controlling, the earlier 2 rent should not be beyond this. So it's restricted to standard rent. 420, 350, 350 will be taken, 370 will be taken, 170 will be taken, 260 will be taken. So you cannot fix beyond this standard rent. But if you take the rent beyond this, then that will be taxable. Government says you should not fix this beyond this one. So if you are fixing beyond that, it's illegal, right? If you are fixing and getting more than this, then on that only you have to pay the tax. Then that is what about the annual rent. Annual rent. Annual rent in this case being 300, 420, 204 and 240. Now gross annual value. Gross annual value is nothing but whichever is higher of these two. 350, 420, 204, 260. To find out the NAV, you have to subtract the municipal tax from here. Municipal tax can be subtracted on satisfaction of 2 conditions. One is paid, that to be paid by owner. So 30,000 paid. This is payable, cannot be subtracted. Paid by tenant, not by the owner, not subtracted. Disputed, unpaid, cannot be subtracted. If he disputed, once the dispute is resorted, finally he may either pay or he may not be paying. So on payment of this one, the later period, you can claim the deductions by the time, not today. Not today. He is not eligible for claiming any deduction for this today. So NAV in this case being 320. Rest of the values being the same value. Okay. Clear? Come on, make note of it. Now, clear? Online students, come on, respond me. Make it faster. Yeah. Now let me introduce a new concept called unrealized rent. What happens if I don't collect the rent? Rent remains unrealized. Okay, how can we treat this? Unrealized rent. That unrealized rent not included in annual value. It can be excluded. So you know that municipal value, fair rent between these two, whichever is higher will be taken. Comparing with the standard rent, you can find out the expected rent, which is whichever is lower of earlier to whichever is lower. This is called expected rent. Actually, you take the annual rent, you know, annual rent is nothing but the rent you receive if it is let out for all the 12 months and without any default if you are receiving. Practically, sometimes there may be default also. In case of any default, named as unrealized rent can be subtracted here. Then it is called rent received. Rent received. So I have to take the rent received. Rent received is nothing but annual rent minus unrealized rent. Annual rent is nothing but if the property is let out throughout the year and without any default, how much we could have collected is called annual rent. From there, any unrealized rent can be subtracted. Provided to subtract this unrealized rent, it should satisfy the condition laid in rule number 4. Okay, what's that? Rule number 4 condition. One is the bona fide tenancy. Bona fide tenancy means you have let out this for third party only. You have let out this for third party only. Is that clear? So sometimes what happens, you can accommodate your family or your brothers and parents or your cousin, one of your own house properties, stating that, sir, I'm not getting any rent. As he is my brother and he is my cousin, I cannot get on my friends. How can I collect? You cannot say so. If you are accommodating your relatives and your friends and stating that you don't get, then it's not bona fide, it's not original let out. It should be bona fide. Unknown party genuinely have let out for rental purpose and you fail to collect. Second one being, the tenant is not paying the rent, defaulting tenant, and he has already vacated. He has vacated. After the vacating, we came to know that he has failed to pay 2 months rent. Now hereafter I cannot collect. Already vacated. Or he is not paying the rent and not vacating, then I am taking the steps to vacate him. Okay. And assessee has taken the legal steps for recovery of unpaid rent. Okay. As he has not paid, I can take the legal actions on him to recover. Genuinely. So, verify the unpaid rent. The unpaid rent may be 10,000 rupees. To recover, if I take the legal action, I need to pay 15,000 for the legal expenses. I may then forego that unrealized rent without any possibilities of recovery. Any who have taken the steps to recover, right? So that steps to recover that unpaid rent will also be there. Number 1 being the bona fide tenancy. Number 2, the defaulting tenant has already vacated or I have taken the steps to vacate him. Not only that, I have taken the legal steps to recover the unrealized rent. And one more point, this tenant has not occupied any other property of my own property. Okay. A being the owner and B being the tenant. Okay. So, A has given a residential house property in Trichy. He is not paying the rent. The rent remains pending. The same B is occupying one more property in Chennai. One more property in Chennai. Okay. Whose property? A's property. And for that, the rent is promptly paid. Then it's cheating, like, no, why is not paying the rent here? Why is paying here? The same party. So the defaulting tenant is not the occupation of any other property of the same assessee. He should not be occupant of any other property of the same assessee. These 4 conditions should be satisfied to disqualify or sorry, to subtract from the annual rent. So rule number 4, bona fide tenancy. The defaulting tenant has vacated or steps have been taken, and defaulting tenant is not occupations of any other property of the SSE. Fourth one being and legal steps taken to recover. Rule number 4, income tax rule. Already we studied in perquisites for the calculation of taxable value. Rule 2B, B and all. Okay. Similarly, here we have to go and refer the income tax rules. Rule number 4 states the unrealized rent to be deductible. For that, what are the conditions should be satisfied? Come on, try to solve this illustration. Mr. Rajan furnishes the following particulars in respect of his income, his house property let out for the previous year 24-25. You can straight away take with expected rent here for A, B, C, D, 4 house properties. 4 house properties. Municipal rent and fair rent, between these two, whichever is higher, and comparing the standard rent, whichever is lower will be taken. Anyhow, I will just calculate completely. A, B, C, D, rupees in thousands. Annual rent, municipal tax, everything is given. Number of rent month for which rent remain unrealized. Conditions of rule number 4 not being satisfied for property D. For this, the condition not satisfied, then this will not be qualified to deduct. And rest of the 3 can be deductible. Rest of the 3 can be deductible. Now, municipal value 500,000, 300,000, 400,000, 200,000. Fair rent 560, 350, 375, 150. Between these two, whichever is higher will be taken. 560, 350, 400, 200. Standard rent, whichever is lower will be taken. 460 not applicable, 360 not applicable. Then this value will be called as expected rent. 460, 350, 360, 200. 200. Is that okay? Now, I have to find out the rent received. RR is nothing but annual rent minus unrealized rent, where rule number 4 satisfied. Okay, annual rent 5,40,000. 1.5 month rent remains unpaid. Then 10.5 months rent you have to calculate. Okay. In this case, 10.5 divided by 12. Come on, tell me. 5,40,000 for the 12 months in rent. Annual rent means 12 months. If it is let out, what could be the rent? That will be the annual rent, which is 5,40,000. Yeah, in that 1.5 month rent not received, so balance being 4 lakhs, 4,72,500, 4,72,500, and here 3 months, so into 9 by 12, 420 for a year, collected only for 9 months, 350. And 390 for a year, 315. Okay, 315. Yeah. And 1 month not collected, so into 11 by 12. This 390 for 12 months rent, 11 months rent is collected. How much is that? 357.5. 357.5. In case of D, of course, rule number 4 not satisfied, you have to take full value. Now, between these two, whichever is higher will be taken for GAV calculation. In the very first case, 472.5, second case 350, 360, 300. Of course, you can subtract the municipal tax. Municipal tax paid by owner, so you can subtract this one comfortably. 60, 42, 36, 12. Then the value what you arrive here is called NAV 412.5. Here 308. Here 324. 288. 288. Clear? Hope you will be able to now understand this. Now let's deal with vacancy elements. Vacancy elements. So we have studied unrealized rent. Now it's vacancy elements. Unrealized rent is nothing but where the tenant occupied but failed to pay, defaulted. Then it's called unrealized rent. No one occupied, remains vacant. Probably one of the tenant vacated. Before we ask other person whether we let out to the other person, it remains vacant for 3 or 4 months. How can I get the rent? If I don't get the rent due to the vacancy, I can claim the deductions. In that case, how can we calculate the GAV, gross annual value? Listen, very, very important. Municipal value, fair value, fair rent. Between these two, whichever is higher will be taken, and then standard rent will be taken here. Between these two, whichever is lower will be taken. That value is called expected rent. With that expected rent, you have to take rent received. What is called rent received, sir? From the annual rent minus unrealized rent minus vacancy allowance. Of course, we don't have the unrealized rent here. You can subtract the vacancy allowance. This is what about the rent received. Rent received. Clear? Now, you have to calculate one more number, rent received plus vacancy rent. Rent received plus vacancy rent. Okay. Now I'm going to calculate the GAV here. GAV in this case being cross verify this number and this number. These two numbers are cross verified. Okay. If expected rent is lower than or equal to rent received plus vacancy rent, okay, then RR will be GAV. RR will be rent received will be the GAV. You have to compare the rent received plus vacancy rent with the expected rent. Then the expected rent is lower, then it's a genuine case. It's a genuine case. Then actual rent what you receive will be considered for the GAV. Is that okay? See, government says your expected rent being 10,000 per month. Your expected rent being 10,000 per month. Naturally, 1,20,000 rupees. The rent received, the actual rent he fixed annual rent being only 8,000, then it's cheating only, no. Isn't it? If the actual rent fixed by the tenant or owner is less than the expected rent, it's cheating. Then automatically we have to take this one. That's why if the actual rent being 15,000 and the annual rent should be 1,80,000 rupees, but annual rent he received is only 60. What does it mean? In that year, only 4 months were let out. Remaining 8 months remains vacant. So he says, sir, I collected only 60. Immediately department questions you. You collected only 60? Yes, sir, I collected only 60. Out of 120, you collected 1 lakh, only 60, right? What could be your actual rent if you let out those vacant period also? Then he calculates this way, sir, 60. If I could have let out these 8 months also at the rate of 15, I might have received how much? 1 lakh 20, 1 lakh 80, sir. 1 lakh 80, which is more than the expected rent. Happy, you are genuine. You are genuine. So your GAV in this case being 60, actual rent what you receive will be taken. If your rent receipt plus vacancy rent is higher than the expected rent, it's a genuine case. So I simply consider your rent receipt as your GAV. Suppose he says my annual rent monthly rent being 5,000, but for the year I collected only for 4 months 20,000 rupees. Immediately government inquires, what about if it is let out for the entire 12 months? Sir, entire 12 months means 20, no? Another for 8 months per month 5,000. Another 5 into 8, 40,000 rupees, sir. I may get only 60, sir. I may get only 60. The rent you could have collected is only 60, but expected rent is 120. Then it's cheating. I don't consider your case. Then automatically what will I consider? Expected rent will be your GAV. Is that clear? Now, if the expected rent is higher than the rent received and vacancy allowance or vacancy rent, then it is cheating. Like so, actual rent what you take will not be will not be considered for the GAV calculation. Then expected rent will be the GAV. Expected rent will be the GAV. Clear? Let me solve this illustration for your better understanding here. So, Mr. Shankar furnishes the following particulars in respect of his house property let out for the previous year 24-25. Kept vacant for 2 months for letting out to a friend who could not turn up. D. In the D case, no, 2 months kept vacant for his friend. It's not genuine case. It's not bona fide, so it's not deductible. Okay, rest can be deductible. Now, come on. For A, B, C, D. Keeping the 3, I can directly take the expected rent. Between these two, whichever is higher, between these two, whichever is lower. So 70 will be taken here. Here, between these two, whichever is higher, between these two, whichever is lower, 1,25,000 will be taken. Between these two, whichever is higher, 60. Between these two, whichever is lower, 50 will be taken. Between these two, whichever is higher, 150, 140 is scored out, and between these two, whichever is lower, 130 will be taken. Expected rent. Right. What about the rent received, sir? Rent received is nothing but annual rent minus vacancy rent. Annual rent. Annual rent is nothing but if it is let out for the entire year, how much will you get? That's called annual rent. Annual rent received is 80,000 rupees. 2 months rent is not received. So into 2 by 12, I think 16,000 not received. So this is what about the annual rent minus vacancy rent. So 80,000 rupees would be taken here. Here 42,500. Here nil. Nil. Here 1,10,000. 1,10,000. Is that okay? Clear? 1,10,000. But in this case, this 2 months is not considered. Then that will not be taken at all. So you have to take the full value, 1,32,000. It's not a genuine vacancy. The next step, you have to find out what could be the actual value you could have received. Rent received plus vacancy allowance. Rent received plus vacancy allowance. Now tell me, here the value being 96,000, 1 lakh 2,000. Here this remains vacant for the full year, so 0. Okay. Then here 1 lakh 10,000. 1 lakh 10,000. Sorry, 1 lakh 10,000, 132. 132. Now you have to find out the GAV. To find out the GAV, you have to cross verify with these two. What is that? GAV is equal to usually what the rent you receive will be taken, provided it should be genuine. How can you check the genuine? The rent what you receive along with the vacancy allowance or vacancy rent should be higher than the expected rent, then I can take the rent receipt. Else, the expected rent will be taken. So this is higher than this one, so rent received will be taken. This is not higher than this one, so it is cheating. So I automatically I will take 1,25,000. The expected rent will be taken 1,25,000. Here rent received, here expected rent. In this case, you cannot argue that it remains vacant for the full year unless you prove you cannot claim the deduction. So you have to take the entire 50,000 rupees. In the last case, it's not genuine vacancy, so you have to take the full value 1,32,000. You are not allowed to deduct this. Okay. Now from that you can subtract the municipal tax. The municipal tax in this case being paid by owner, so you can simply subtract this one. So 8,000, 15,000, 13,500 and 14,300. Now final value being NAV. NAV in this case 72,000, 1,10,000 and 46,500. This is 3,500. Sorry, this one is 3,500. Then the value being 46,500. Finally, this value being 1,17,700. Clear? Come on, make a note of it. We'll continue the rest in the next class.